several AI power companies are emerging as strong competitors to Nvidia. These companies are leveraging advanced technologies and innovative strategies to enhance AI capabilities. Their focus on specialized AI hardware and software solutions is driving significant advancements in the industry, challenging Nvidia's dominance and reshaping the AI landscape. Warren's Money Buffet emphasizes that it is not a tax, legal, or investment advisor. The content is purely informational and not associated with Warren Buffett or Berkshire Hathaway. Here's what's on the menu for today's video. We'll start with the AI revolution and why the story goes beyond Nvidia. Next, we'll look at the explosive growth in AI data center energy demand and why that matters for investors. I'll highlight key AI power companies and infrastructure enablers you should watch. We'll compare growth outlooks, discuss investment advantages, and review recent market performance and analyst sentiment. Then we will cover Tesla's Robotaxi from an investment perspective. Robotaxi landscape. What is the potential and risks? Let's get started. Nvidia's graphics processing units dominate the artificial intelligence chip market, fueling applications like ChatGPT and autonomous vehicles, with significant stock growth expected by 2025. Utilities and infrastructure firms are crucial, providing necessary energy and grid upgrades, making them pivotal in the artificial intelligence revolution beyond just chips. AI data centers are experiencing a 20% annual growth in electricity demand, with projections indicating they will consume 8% of global electricity by 2030. In the United States, data center power usage is expected to double by 2030, highlighting the critical need for expanded energy infrastructure to support this surge. Let's put some numbers to this. AI data centers are now growing their electricity usage by more than 20% every year. By 2030, data centers could use up to 8% of all global electricity. That's a staggering figure. Think about every server farm, every AI model, all needing reliable, scalable energy. This is creating a massive tailwind for utilities and infrastructure companies who are racing to expand capacity. Here's why I think AI power companies are set to outperform. First, exploding demand for electricity gives them pricing power and growth visibility. Second, most are still in the early stages of this growth cycle, unlike Nvidia, which is already priced for perfection. Third, their valuations are much lower. Utilities trade at 15-20x earnings, while Nvidia is over 40x. Fourth, they offer defensive growth and steady dividends, which look attractive as rates fall. Finally, ESG and regulatory trends are pushing for more renewables and nuclear, which benefits utilities investing in green energy. In short, these companies combine growth, income, and stability, a rare trifecta. While Nvidia gets all the headlines, utilities and infrastructure firms are the unsung heroes of the AI boom. They're building the new power plants, expanding the grid, and delivering the clean, reliable energy that AI data centers need. These companies are quietly securing decade-long contracts and positioning themselves as essential partners for big tech's AI ambitions. Let's spotlight some leaders. NextEra Energy is a giant in renewables, signing huge deals with AI data centers. Constellation Energy is ramping up with its carbon-free nuclear fleet and new AI contracts. Duke Energy, Dominion, and Southern Company are expanding grid capacity in the Southeast, where AI data center growth is booming. Nuclear specialists like BWX Technologies and Talon Energy are seeing surging demand, while infrastructure enablers like Eaton, Siemens Energy, and Vertiv provide the critical power and cooling solutions that make these data centers possible. Let's dig into the enablers. Eaton delivers modular, scalable power systems, ensuring data centers have uninterrupted, efficient energy. Siemens Energy is at the forefront of smart grid tech, helping integrate renewables and manage huge power loads. Vertiv specializes in power management and cooling, critical for keeping AI servers running 24/7 without overheating. These companies are the backbone of the AI infrastructure boom, and their solutions are in high demand as the sector scales up. How do these companies stack up? Nvidia's revenue is projected to grow about 30% in 2025, thanks to its AI chip dominance. But leading power companies are forecasting 15–20% earnings growth, remarkably high for utilities. They're also reporting record project backlogs, with over $10 billion in AI data center contracts. As AI adoption accelerates, these recurring revenues and infrastructure upgrades will keep compounding, making utilities a compelling long-term play. Let's talk investment advantages. Utilities and infrastructure stocks trade at much lower valuations than Nvidia, offering more upside potential as investors rotate toward stable AI infrastructure plays. They pay consistent dividends, usually 3–5%, so you get income and growth. Their earnings are less volatile, backed by long-term contracts with tech giants. They're positioned for sustained growth as AI data center expansion drives recurring revenue. On the flip side, their growth rates are a bit lower than Nvidia's, and they don't get as much media buzz. But for investors seeking stability, income, and exposure to the AI trend, these companies are a smart addition. Let's check the scoreboard. The Utilities Select Sector SPDR ETF, XLU, has rebounded strongly this year, reflecting renewed interest in the sector. Constellation Energy is up sharply over the last 6 months, and NextEra has bounced back from last year's lows. Analysts are increasingly bullish on these names, citing record project backlogs and double-digit earnings growth guidance. In contrast, the S&P 500 is up, but much of that gain is concentrated in a handful of mega-cap tech stocks. The takeaway: the market is starting to recognize the value in these power and infrastructure plays. Of course, there are risks. Nvidia's sky-high valuation means any misstep, like a product delay or new competitor, could spark big volatility. Power companies face regulatory hurdles and must secure rate approvals, which can slow growth. Utilities are also slower to adapt to rapid tech shifts compared to nimble chip makers. That said, their long-term contracts, defensive earnings, and focus on renewables make them a stable counterweight to high-flying tech stocks. The AI revolution is a high-stakes game, but power companies are the steady hands keeping the lights on. Here's a game plan for investing in AI power infrastructure. Build a diversified basket. Combine leading utilities, nuclear energy, and infrastructure stocks to capture the full spectrum of AI power demand. Focus on dividend growers with strong balance sheets, like Consolidated Edison and Duke Energy, for steady income. Watch for pullbacks. Market volatility can create buying opportunities in quality names like Brookfield Infrastructure, Partners, and Enbridge. Most importantly, think long-term. AI power infrastructure is a decade-long growth trend. Hold these stocks for compounding earnings and dividends, and review your portfolio regularly to stay on track. If you found this analysis helpful, please subscribe to Warren's Money Buffet for weekly deep dives on AI investing trends and market updates. Share this video with anyone who thinks Nvidia is the only AI winner. Let's broaden the conversation. And leave a comment with your favorite AI infrastructure or power stocks. Let's build a community of smart, forward-thinking investors. Stay tuned for future updates as the AI ecosystem evolves. Now on to Tesla. Switching gears, let's talk about Tesla's highly anticipated Robotaxi launch. Tesla plans to officially roll out its Robotaxi service on June 12, 2025, starting in Austin, Texas, with a small fleet of modified Model Ys. This marks Tesla's first real step into commercial autonomous ride-hailing, a milestone Elon Musk has been promising since 2014, but it's arriving years after competitors like Waymo, who already have a big head start. Let's see how Tesla stacks up. The robotaxi market is heating up fast. Waymo, owned by Alphabet, was first to launch, rolling out services in multiple cities and scaling from 10,000 weekly rides in 2023 to over 250,000 today. Their market share now tops 25% in some cities, putting pressure on traditional rideshare giants like Uber and Lyft. Tesla's late entry means they're playing catch-up, but their massive fleet and brand power could still shake up the landscape. Tesla faces some big challenges. Their robotaxi launch is starting with fewer than 10 cars in Austin, much less testing than Waymo did before going live. City officials have raised concerns about Tesla's readiness, especially around safety plans and first responder coordination. There's also a fierce debate over Tesla's technology. Musk insists on a camera-only system, while competitors use LiDAR and radar for redundancy. This has sparked skepticism about Tesla's ability to match Waymo's safety and reliability. Let's talk money. Waymo's robotaxi revenue is still small compared to Uber's, but the market potential is huge. If Tesla can scale up, even a small share of the ride-hailing market could mean billions in new revenue. But it's a high bar. Tesla needs to prove it can deliver reliable, affordable rides at scale, and that customers will trust fully autonomous vehicles. The stakes are high, and investors are watching closely. Tesla's current stock price bakes in a lot of optimism about robotaxi success. The company trades at over 180 times earnings and 11 times sales, reflecting sky-high expectations. But the robotaxi business is still unproven. There's limited testing, regulatory hurdles, and plenty of competition. Any delays, safety incidents, or disappointing results could trigger a sharp correction. For investors, it's a classic high-risk, high-reward scenario. Let's highlight what the community is saying. Many commenters are skeptical, citing Tesla's rushed launch, limited testing, and safety concerns. There's also a heated debate over Tesla versus Waymo. Some praise Tesla's scale and integration, while others think Waymo's cautious approach is safer. Investors are split on profitability, pricing models, and whether Tesla can actually disrupt the rideshare market. These debates show just how uncertain and polarized the outlook is. On the bullish side, commenters point to Tesla's massive fleet, over 7 million vehicles, as a unique advantage for rapid robotaxi deployment. Tesla's vertical integration, from manufacturing to software to charging, could lower costs and speed up rollout. Supporters believe Tesla can disrupt Uber and Lyft by eliminating driver costs and expanding globally. There's real excitement about the potential for Tesla to lead the next wave of mobility, but there's no shortage of criticism. Skeptics argue that relying only on cameras is risky, especially compared to Waymo's multi-sensor approach. Some question Elon Musk's credibility, citing past overpromises and missed deadlines. Others doubt the business model, pointing to high vehicle costs, low utilization, and uncertain profitability. These are valid concerns that investors should keep in mind when evaluating Tesla's robotaxi ambitions. Of course, no online debate is complete without some roasting. Here are some of the more colorful comments. Tesla's robotaxi is a fantasy? Tell that to the millions who park and let their car drive itself. Critics say Musk's tweets tank Tesla, but hey, who else can land rockets and make cars drive themselves? Tesla's tech is years behind because copying Waymo's LiDAR is obviously the shortcut to success. These tongue-in-cheek takes show just how passionate and divided the community is about Tesla's future. Safety is front and center in the robo-taxi debate. Waymo has reported 97 accidents and 35 injuries in 18 months in just 2 cities, San Francisco and Phoenix. Tesla's FSD system has also faced safety incidents and critical issues in testing. Regulators are watching closely, and public perception is shaped by every headline. Waymo spent a year coordinating with officials before launching, while Tesla's Austin rollout has been criticized as rushed. The technology approach also differs. Waymo uses LiDAR, radar, and cameras for redundancy, while Tesla relies solely on cameras. This difference fuels ongoing debate about which approach is safer and more scalable. Let's compare the tech. Tesla's full self-driving depends only on cameras and neural nets, aiming to mimic human vision. Elon Musk argues that adding more sensors causes confusion and cost. Waymo, on the other hand, uses a multi-sensor suite, LiDAR, radar, and cameras, to build a detailed 3D map of the environment. Experts say LiDAR is crucial for reliability in all weather and lighting. Musk disagrees, insisting that roads are designed for humans and cameras. The jury's still out on which method will win, but the stakes couldn't be higher. Running a robotaxi fleet isn't cheap. Tesla must cover vehicle depreciation, maintenance, insurance, and network costs, unlike Uber, which relies on freelance drivers. Tesla aims for a $10 trip price with a 40–60% take rate, much higher than Uber's 15 to 20%. But high utilization is essential for profitability, and it's unclear if Tesla can achieve that scale. Waymo, despite years of operations, is still unprofitable. It may take years before robotaxis make a meaningful impact on Tesla's bottom line. Tesla's stock is priced for robotaxi success, with a P/E ratio over 180 and sales multiples above 11x. Bulls point to Tesla's scale, integration, and disruptive potential. Bears highlight missed deadlines, technical challenges, and tough competition from Waymo and others. Investor sentiment is mixed. Some see robotaxis as a game-changer, others as a risky bet already baked into the stock price. If Tesla stumbles, there could be a sharp correction, but if they deliver, the upside could be huge. Here's how the rollout is expected to unfold. Elon Musk introduced full self-driving years ago, setting the stage for robotaxis. The cybercab concept signals Tesla's intent to launch a dedicated robotaxi vehicle. The Austin launch starts small, with 10+ Model Ys, before scaling up to hundreds of vehicles and expanding to new cities. Production of purpose-built cybercabs is projected to begin soon, with a goal of 2 million vehicles. This timeline shows Tesla's ambitious roadmap, but execution and regulatory approval remain big hurdles. In summary, Tesla's robotaxi launch is a bold move with massive potential, but also huge risks. The technology is promising, but not yet proven at scale. Regulatory, safety, and business model challenges remain. The stock price already reflects a lot of optimism, so investors should be prepared for volatility. Cautious investors may want to wait for more data before jumping in, while risk takers could see this as a long-term opportunity. As always, do your own research and weigh the risks carefully. Thanks for joining me for this deep dive into AI power companies and the Tesla robotaxi debate. If you enjoyed the video, please like, subscribe, and share your thoughts in the comments. Your feedback helps us grow and keeps the conversation going. See you next time on Warren's Money Buffet.